Hello friends, welcome to Nirmal. I am Piyush Jain and you're watching a special earnings review conversation. With me today, joining the show, is Mr. Manoj Verma, the Chief Operating Officer of Bikaji Foods International Limited. Manoj sir, welcome to the show.
Thank you so much, Piyush.
And Bikaji, I think all the investors, all our viewers, actually, they would be remembering, having very fond memories. The stock basically was recently listed, saw a blockbuster listing. And after that, again, it has been having a stupendous sort of upcurve also in the stock market. We actually now, this is the second result again, which has come post the listing. Numbers basically have been quite good. Again, if you take a look at the revenue, those actually are up 16% versus the last year, but the profit performance has been far stronger than the revenue because of margin expansion. Net profit is up almost 195% versus last year on a consolidated number basis. Manoj, the numbers actually have been quite good from a bottom line perspective also and a revenue perspective also. Help us understand beneath the numbers, how has been the volume growth?
So volume growth, if we look at on a YTD basis, we've grown at about 16% volume growth and overall at 24% growth. So that's it. In fact, if we look at in quarter two, volume growth was very good. That is also because a huge seasonality impact on that stuff as well. And quarter two overall for us was also very good. And the reason was none other than Diwali last year was little early, so there was a business shift which happened more towards quarter.
Right, 16% volume growth again is actually a solid number here.
Yeah.
So, which also tells us that the pricing has been stable because again it matches with the revenue here. Uh, from the headline numbers for the quarter, the third quarter, what really has worked for you, and what has been the reasons for the strong volume growth?
So for quarter three, if you look at now our continued focus on distribution, which is what we have called out as a part of our strategy, our focus on premiumization, so selling which gives us higher realization, right? These are the factors which has really helped us. This is pure organic growth, so to say. Other than this, if we look at so now that we have our new units firing for us, which is where we produce, the Western snacks, and now all over in the core and the focus states. I mean, they've also started adding the volume and the growth to us.
Right, and I was taking a look at the numbers, and the numbers actually have been strong. From a perspective of snack business, ethnic has grown by almost 23% for the first 9 months YY. Western snacks has grown by 95%. Again, yes, the base might be slightly different, but still strong growth here. We have seen a decline in the packaged sweets, and Papad, which again has been a sort of historical leader, it has done well, has been stable. So before I talk about snacks here, I wanted to know why packaged sweets are declined. Traditionally a festive quarter, but what is the reason?
So, see, I think it's not fair to look at just quarter three. It is wise to look at quarter two and quarter three put together, which is what I was telling. That last year, if we look at, Diwali was little early, and hence quarter two numbers for us this year were by far higher. So, sum total, if you look at, quarter two and quarter three putting together, I think it's not a disappointing number. It's well in line with what we have called out.
Right. So important point here. Again, basically the festivity, the shift of the festivity from second quarter, third quarter, that perhaps is also causing a sort of a swing here. On a 9 month basis, packaged sweet segment has grown by 18%. So this is what I think Manoj actually is highlighting here. Coming to
And
the sure,
And
please.
Piyush, it's important to look at while we only report our revenue numbers, which is primary. When we look at our secondary numbers, so in quarter three, in quarter two, it was more of loading, like modern trade, even all distributors at all stores. But secondary actually happened in quarter three itself. So when I look at my secondary numbers quarter on quarter, so I think they are well in line with one over another.
Just for the understanding, because the stock, the business again is new to the investors who have been following the company. I won't say that the brand is new because the brand is decades long and people, everybody in India knows Bikaji. But from a stock perspective, if anybody is following the results and reading the numbers quarter again, how they should really read the business here? Is there a seasonality factor here? they should read YOY or quarter numbers are also good? How you would actually help them?
So Piyush, we will put it like this. If you look at now, our quarter two and quarter three put together is almost about 54-55%.
Okay.
So it is not much of a seasonality impact. So quarter one normally is about 22%. Quarter two, quarter three, I said is there's impact of Diwali, that when Diwali comes in. So quarter two could be larger than quarter three or vice versa. But sum total would be around 54%. And the quarter four is about 24%. That's where we build the ARR running rate high towards the last quarter, and that's how we get into the new financial year. This is what has been historically, if you look at.
Then actually I would summarize it like a sort of almost stable through the year, because quarter two, quarter three festivals combined 54%, 24% last quarter, which actually
Right.
tells the first quarter, and 22% another the first quarter. So combined everything I think looks like 25% odd here and there. So
That's
that's
right.
a good learning here. Um, from there, let's also understand how's the trend looking like, because I remember the last conversation and what the company has been talking about. You have been planning the distribution footprint expansion. Railways was one segment. The canteen was one segment. How's the distribution footprint looking like for the next quarter, the fourth quarter, and moving on over the next 2-3 quarters? What we should expect?
So pleased to inform that we are now listed brand in the CSD canteen, which is, if one was to count it as a modern trade outlet, so which is the largest modern trade retail outlet in terms of number of stores and also the volume, we are now there. Uh, though it's too early to make a statement on this, but yes, 8 plus 8, almost 16 SKUs are getting listed there. So this will purely be a additional delta for us. That's one. Talking about our distribution, we are that's a called out strategy for us, and which is what we are heading towards, increasing our distribution both in our core and in focus states. Talking about how do we look at next quarters and all that, we are really excited because from the back end perspective, if we look at all our units which were to come up are there to support sales, which helps us with the availability and the fill rate at the back end. So therefore, pretty excited, and I think this momentum should be on.
Okay. And from the perspective of geographic expansion, I know again there's a lot of distribution footprint which you have covered, but what we should be expecting in terms of expansion there?
So expansion, if you look at in terms of number of states, so we will stay with these states. So we call focus states, which are six in number, four from North India, which is Delhi, Punjab, Haryana, and UP, and two from South of India, which is Telangana and Karnataka. So these states would continue to be same for next 3 years. However, if you look at in terms of our coverage, we will more than double, our direct reach in these states. That's the kind of number what we are looking at.
Okay, interesting. So canteen and then also geographic expansion is what we're talking about. I'll come back to sort of discussion more on that, but wanted to talk about the numbers here. I noticed that the gross margin actually were looking healthy. They actually had expanded, which again is a good sign. So on a gross margin expansion, help us understand on the raw material prices. We talked last time that the raw material prices have softened up a bit. Last year was very volatile, was very strange also, and now we are seeing a cool off in the prices here. So how much was that a contributor, and how's the trend looking like on the raw material prices?
So gross margin, certainly, the prices have cooled down for raw material, and what in fact at the peak during quarter one. So there's softening in prices, so that has helped us improve our gross margin. Going forward, what we see that this momentum should continue, but what we are seeing is that pulses are now picking up. I mean, so they certainly will not go back to the quarter one level, but for what they are, I think they may not stay for very long, like peanuts and all. That's what we see. But the EBITDA, the kind of EBITDA what we are delivering, we'll continue to deliver because the savings we'll bring in from our efficiencies, internal efficiencies, what we are working on. Each function has the target to bring down the cost. How's that we can get back to the organization and to the bottom line. That's what we're doing.
Can you help me with your top two raw material costs that could be? Like could be edible oil or could be anything. Is that possible?
Yeah. So first is the topmost is edible oil, which is huge, followed by moat dal.
Okay, fine. Sounds good. And yes, we have already seen the sort of edible oil prices. Those actually have stabilized in the last month. So perhaps, as you are just indicating, that sort of softening up is now plateauing out. So I think that you would be highlighting it. From there, again, if I take a look at the numbers here, sir, one thing we actually have noticed is that the gross margins have improved, but we have seen a jump in the depreciation, and we have also seen a jump in the other expenses. So I will first ask you on the other expenses. Help us understand the decode, help us actually rather decode these numbers here. Why there has been a continuous sort of increase here?
So jump in depreciation first. Let me take first question first. So that's basically post auditors report and all that stuff. So the acquisitions and all that stuff. So that's a outcome of the audit report, and which we were to put it, take it in our balance sheet. That's one. It is not as much. More importantly, what it is that if you look at our marketing expense for this quarter is about 3.5% against the budget. What we have is 2% or less
Okay.
than 2% because of season. So this was the quarter wherein our spends on media was the highest, and therefore that incremental 150 basis point is coming on that account itself. Whereas
Okay.
gross margins have gone up, but EBITDA has come down. Is This is the only reason. Rest all other lines, if you look at, we have shown improvement on.
Okay, sounds good. So, 150 basis point basically is the marketing spend here. From a depreciation point of view, do you further sort of expect to see uptake in terms of the depreciation, or you basically are now expecting that the assets are going to sweat more, so perhaps more about revenue picking up?
No, no. So this was only one-time stuff. I mean, going forward, you will not see such aberrations in any of that. So this was basically correction based.
Right. And like, I don't know if the numbers would be handy, but I'm still asking. Um, what's the sort of average asset turnover you feel happy when you actually open any new plant or you actually judge any new plants? What would that number be for you?
I think it's 3.5 to 4 times. That's what we look at.
Okay. Sounds good. Sounds good. And from there, sir, now let's talk about overall the sort of sector. We basically would be crossing the budget in the few days time, and then basically we'll start looking at the 12 months from there. From a edible sort of sector, food sector, or discretionary consumption sector, whichever way actually we want to paint it. But what would be our expectations from the budget, or from the government, or from the policy environment?
I think this should be, consumer friendly, people friendly. That's what we expect. Edible oils are well, under control. In fact, the numbers what it went up to and now where it is. So it's always in terms of relativity, people feel much relaxed, which is what it is. So we don't expect, much of a change. It will be a, a consumer friendly budget, and we also expect that if inflation doesn't go the way it went last year, so maybe companies would be willing to pass it back to the consumers as well. That's what it is. I'm seeing certain increase in grammage consumer offers which are there in the pipeline, and that's good for from a consumer point of view, which will
Just
help them grow faster. Yeah.
Okay. Just squeezing in one more question here, and that would be any sort of rejig in any import or custom tax on the edible oils, could be palm oil, soybean oil, any oil. Is that something which is a big delta for you? Is that something which is there as a wish list for you?
No, it's not. No, in fact, it's a very, very mass commodity. And across food sector, if you look at wheat biscuit, which is one of the largest category, wheat savories, and also it's a mass consumption product. I don't see that anything would happen or government would even wish to do that stuff.
Okay. Okay. So I think basically we have covered almost all the financial part for the results here. My last question to you, sir, and that would be from a competitive intensity perspective. We have seen a sort of lot of volatility and a lot of also again a sort of tough time last year for the sector per se. Uh, from a broader sector growth perspective, industry perspective, how basically now you're looking at the fourth quarter and the sort of FY24 as it is coming to you, how much confident you are feeling, how much sort of strength you are seeing the demand right now?
So I think there's a lot of work which has happened within our organization at the back end, at the front end, right? I think team is pretty charged, happy to take the challenge coming forward. The way we have increased our capacities, I think that definitely come handy for us in the years to come. Talking about demand, so certainly demand is not a challenge. In fact, what we expect industry to grow is at about 15 to 16% this year also. However, our growth would be by far higher than the category growth. So therefore, we are looking to gain shares as well in the years to come.
And Manoj, any new products you want to share with us, which Bikaji will be looking to launch over the next 3, 4, 6 months?
So, healthy food is a buzz. There's a lot of products in our pipeline, which one can call it a healthy product, right? So, which is a roasted range of roasted namkeen, range of multi-grain products. That's what, we already have started. But I think market is not as matured at this point in time. So, maybe it will take
True.
few more years. But, from readiness point of view, yes, company is in line with what, future is to be. So, we are already there.
Well, that's a great conversation. Again, if we sort of sum up for our viewers, again, as Manoj has explained, the spike in the depreciation, he's explained other expenses, largely a marketing expense delta here, 1.5%. That's why we saw that spike. Strong numbers, Q2 and Q3 combined. That's the view because of festivity sort of switch here. But overall, very strong 16% volume growth number coming from the FMCG major. Newly listed company, second result, and another strong growth coming your way. Manoj, thank you for coming on the show and helping us in decoding the results. All the wishes to you for the fourth quarter and FY24.
Thank you so much. Thank you so much.
And dear viewers, with that, it's a wrap on the show. Hope you enjoyed it.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.